we are going to look at something very interesting over the next hour or so. What we're going to look at, some of the benefits of using order flow in trading, for those new to order flow, and a refresher for those that are already using it and maybe kind of struggling, have lost their way. What I'd like to do now is just kind of relax your shoulders, limber up a little bit, and put your learning hats on, because what we're going to do now, we're not going to do a big sales pitch. We're actually going to talk about reading the market. We're going to talk about reading the market, the way that many prop firms I work with actually read the market, actually using some techniques from proprietary trading firms that go out, find people who look really smart and who they think would make good traders. They will teach these people, pay them a stipend salary while they're training them. They will train those people, and then they will give them money to trade. They don't accept money from traders for trading. Their job is just to find traders and turn them into little money-making machines. And they use certain techniques that, for a long time were kind of hidden from most retail traders, but that nowadays are, becoming a lot more accepted in the retail trading world. Now, we are going to have lots of time at the end for questions. And what I find is usually as we go along, I'll actually end up answering some of the questions you have as we go. So if you can, you're free to type in your questions at any time, but I will answer them at the end, and I will give you a time at the end, and I'll say, okay, questions now. So up to you if you want to hold them till the end or not. Okay, so lots and lots of retail traders I meet every year. Some of them, in extreme cases, have been trading or trying to trade for 20 years and not getting anywhere. Now, the majority of those traders levels, in many cases, trying to determine a point at which the market's going to turn around so that they can capture the majority of the move in a market. Now, what I tend to call those levels where somebody's looking, for instance, they're day trading and they're trying to find the low of the day, I call that trying to find a major reversal point where, the market is actually really having to turn itself around for your trade to work out. Now, other traders are looking for the market to establish some form of direction before looking to get in on a retracement. And I call those minor reversal points, are major and minor, fairly simple, because effectively they take less effort for that move to happen. Now, other traders are looking to capitalize on short-term ranges, which means they're trying to find a range and then looking to sell or buy the extremes of that range. And of course, there's traders that trade breakouts as well. Now, many of the traders also trying to trade a combination of things, and a lot of people tend to lose because they're trying to trade all these different combinations. But basically, all the traders, or most of the retail traders that I come across, they've got one thing in common, and that's that they're looking for levels to trade off. And the dilemma with levels that traders face is actually fairly simple, right? This is a level, and we can turn at a level, we can turn before a level, we can shoot through and then reverse, or we can just carry on straight through and not do anything. So if we wait for the level to be hit directly when we're looking to trade, we're going to miss the opportunities where we turn just before the level, right? So, okay, so instead of doing that, we'll put in a trade before the level. Well, unfortunately, that really increases your risk to make allowances also for the times where it moves through the level, right? Where it runs past and then reverses. So, to try and catch all instances of reversing at a level, you have to actually, turn that price into quite a range of prices. And that really increases the risk for this case when the market runs straight through. And then the other problem you have with levels is, by almost all techniques that are common in the retail world, support and resistance, volume profiling, even stuff like Fibonacci that I'm not a big fan of. On any given day, you can have 3 or 4 levels or potential levels where the market could actually turn around, and you don't actually know which one of those is going to work. So, even if one of your levels works out on that day, you could have 3 or 4 stops before you reach your level. And if you're a day trader, generally speaking, if you're a day trader trying to trade levels, by the time you've been stopped out 3 times, your best case scenario for the winning trade, if you know, if the fourth trade is a winner, really your best case scenario at that point is breaking even, right? So, you know, we have to do something to try and fine tune the entries. And that's what order flow is all about, basically. It's about looking at the activity of traders as we approach these areas. And it helps you analyze behavior of traders after you enter a trade also, to help you decide whether to stay in the market or not. Now, what we're not going to do today, we're not going to talk about the sanity of actually setting levels ahead of time, right? And whether really major reversals are a good place to trade, or whether you should hit on the minor reversal. So we'll save that for another discussion, right? But what we're looking at today is, okay, I've got a level that I want to enter trade. You know, does the behavior of other traders give me a case where taking a trade at that level is a good idea now, whether I should back off a little bit and enter a little bit later? And then once I get in, is that trade actually working out, right? So we've all been in trades. It's really easy to get into a trade. It's a little bit more difficult to know if that trade's really working, you know. And when I say is it really working, I don't mean it's hit your stop or not. I mean, how can you tell, you know, once you're in a trade, whether that trade's actually going to go your way and carry on going your way? Now, the word tape reading is pretty common, and tape reading and order flow analysis are basically the same thing. So you're watching the flow of orders and their impact on price to see how the market participants are acting and where they might be getting trapped. Now, many novice traders, they've got a tendency to look for very mechanical signals. So that would be like combinations of fixed factors and usually indicators that give you a red or a green light to trade. A good example would be a moving average crossover, right? It's just a couple of mechanical factors. You pick the two lengths of moving average, crosses one way, it's a red light, crosses the other way, it's a green light to buy. And the theory is that that is the easy way to trade. But the reality is that the markets, they're not really that mechanical. And even if they were, there would still be billions of combinations of fixed factors to find that one magic signal that works in all markets, all time frames, all conditions, because that's the promise of a lot of these systems. And that's one of the reasons that people spend 5, 10, 15, 20 years without getting anywhere in trading. In fact, I even had one call this morning with a trader, and I said, what are you looking for? He'd been 16 years trying to trade, and one of his prerequisites was, it must be easy. This, whatever I do, I don't mind doing it. I put 16 years in getting nowhere, and the one thing I need to do, it needs to be simple, and it needs to be, you know, just a couple of rules. And it's just this mentality of looking for something mechanical, a magic signal that's going to let you trade without thinking too much. And my question to him during that conversation today was, you know, you want to do something simple, but you've been trying to do that for 16 years. That's been one of your main criteria for 16 years, and you've not got anywhere with that criteria. Can we put that criteria to one side for now, and actually let's kind of discuss what goes on in the industry when professional traders are trained, and actually maybe have a rethink about what simple means, right? So simple means doing the same thing for 16 years and not getting anywhere, or simple means using a discretionary skill, using the kind of skills that you use every day to cross the road, right? You don't cross the road because the moving average of one car coming in the one direction crosses over the moving average of the car in the other direction. You look at the cars in both directions, you make a judgment based on discretion, and you cross the road, and guess what? 99 times out of 100, in fact, I should imagine it's probably a better hit rate than that, you don't get hit by a car, right? And that's just using a discretionary skill. And it's not difficult, but it is just something you need to embrace. And this idea of using your discretion, of using your skills, it doesn't mean you have no rules. And there's also no law that says a discretionary approach is more difficult than a mechanical approach. In fact, the process of working your way through hundreds of mechanical trading systems, it's just like trying to find a needle in a haystack. It's all or nothing. You look, you look, you look, you either find the needle or not. But with discretion, using discretion, you're actually developing a skill. And so you make progress in steps, and those steps, that progress should be measurable. You should know in 2 weeks' time if you're a better trader than right now. And if you get to 2 weeks time and you don't know if you're a better trader right now, it's probably a good thing to do to take a step back and ask yourself why. Why don't you know that? What are you trying to measure? What are you looking for? So order flow is just like reading a story. All stories are different, but they still use the same language. And it's the same with order flow. So order flow has got its own language, and that language describes the behavior of traders. So a good example of this would be a market where you've got sellers predominant in the market and prices moving down to a level that you think is going to be support. And as you get to the area of support, you might see one of the following. So first of all, you might see large sellers participating on the way down, and then the market still goes down, but it's only small retail participation. It's only the little guys trading anymore. So what that says is the behavior of some of the market participants is changing. You might find that you get to your support level and sellers are hitting the market aggressively before, during, and after you go through price. There's basically no observable, let's change this, change in behavior. Another thing you might see, you might get to a support area and nobody wants to sell at a certain price. Might be your support price, might be a few ticks before, a few ticks after, right? You maybe retrace a few ticks, go back to that price again. Nobody wants to sell there. Very, very common, right? So that's a clear and observable change in behavior, a lack of commitment at one or more prices. Very, very common on thicker markets, common on the S&P 500, common on interest rate products. Another thing we could see, we could get to our area and sellers keep hitting the market aggressively. We've got a lot of sellers, but the market is no longer reacting to that selling. It's no longer moving down. Very simply, what that means is sellers are now getting trapped, right? Or we might get to an area and we're selling down to the area. As we get there, suddenly from nowhere, it starts to tick up. We've got large size trades, obvious buy side aggression. And what that means is buyers are initiating a new move up. Again, a change in behavior. Right. Now, those are all things that just by common sense, you must know are possible, right? We can run out of sellers, we can get more sellers, right? This is really not rocket science at the moment. But these aren't things that you can see by just looking at the price. And it's the same also when you're looking at other traders' positions, which is also a part of reading order flow. So consider this image. What we have here, we have a high here and a low here. So that's where price has been. But if you look at the volume profile over here, this is the number of contracts traded at each price. And this is the volume profile. It's just a histogram that represents those number of contracts, right? If you look at where people actually traded the most, where the actual positions are, you see a slightly different story, right? It shows a market where the majority of positions are in this area here, and where we've just had really low volume probes either side, above and below. And that for various reasons, again, we won't go into too much detail, there's absolutely no sign that in this probe above and this probe below here, that any of these traders in the middle here have actually been stopped out, right? And that's purely because of the amount of volume traded there, okay? So I'm not going to go into the different ways we'd interpret this today, but this price here, with the 22,000 contracts traded and the fact that nothing traded right above that price, that is far more important in terms of short-term future market action than this price up here where just 23 contracts traded, right? So these are the traders, these are the people with positions here whose reaction can cause a short-term move in the market and not these guys, right? If 23 contracts get stopped out, it's not going to do anything. If 22,000 contracts get stopped out, it can move the market, okay? Now, the other part of order flow analysis, before we look at examples, we also look at the behavior of what we call resting orders or limit orders in the market and how they are being manipulated. So these are your limit orders here. Now, limit buy orders only exist below the market, and limit sell orders only exist above the market. And if we want to know the difference between a limit order and a market order, a limit order is just somebody out there and says, if you come to me, I will buy from you. So a limit buy just seems, okay, if you can come to me and meet me at my price, I will buy from you at that price. Those get hit with market orders, right? So a market sell order will trade with a buy limit order. Now, of course, because they're not market orders, they're not instructions to buy right now, these numbers here can be manipulated. A couple of ways they do that. They can either hide their real intent, their real size, or they can put in really big orders and then just pull them out of the way as the market gets close to it to deceive you into thinking the market's stronger or weaker than it actually is. So we often see something called an iceberg order, where only a small amount, small quantity is shown on the ladder here, a small amount of bids or offers is shown. And then as we trade there, that number stays steady. So you might see 100 bid, and then 50 sellers sell there, and it's still 100 bid, and then another 50 sell there, and it's still 100, and 100 sell, 200 sell, 300 sell, 400 sell, and you still see that bid at 100. So what you're seeing is the tip of the iceberg, right? And as we trade into it, they just keep adding more and more. And some of the exchanges themselves actually support this kind of iceberg order. So you can send a single order for 1,000 contracts to the exchange and say, look, I want to buy 1,000, but I only want to show 50. I want to refresh when it gets as low as 30, right? Now we also see, as I say, we have spoof orders. Spoof orders basically disappear when price gets close to them. And spoofing is something that recently became illegal. It's not illegal to pull an order, but it's illegal to spoof on the bid side, to put really big bids on here and then see the market go up and then to be selling on the other side. That's kind of illegal. It is illegal. Didn't change a thing when they made it illegal. The only guys that ever got to court and got taken to court over this are very, very small traders, right? So there is still a lot of manipulation there. It was supposed to be outlawed. They haven't managed to outlaw it. I don't think they ever will, and it's not actually a bad thing. And again, this is one aspect of order flow. And like all aspects of order flow, we don't need to use them all at once. In fact, if you look at things like spoofing, it's one of the things that you can see, and I can see when somebody's spoofing the market, not all of the time. It's not something I use myself, primarily because if somebody's trying to spoof or manipulate the market, it's good to be able to see that. But if I try and trade with them, my trade, whether it works or not, relies on two things, and that's one: did I recognize the signs right? Are they really trying to fake the market out? So if I'm wrong about that, my trade will lose. But also, are they successful, right? So if you're watching somebody try and manipulate the market, if that doesn't work out for them, you don't get like bonus points for being right that they were trying, right? So you don't have to use all of these things, but nice to know that these things exist. So, don't think of order flow as like one set of techniques. Basically, order flow tools, they're all based on a common set of concepts. So think of order flow in the same way you think of price charts. The order flow tools present certain information in what we think is a logical manner. And like price charts, there's lots of ways to use that information, but there isn't just one way, right? There is not just one way to use order flow tools. But one thing you should do, and absolutely essential, I know there's some people here that have been using order flow for a while. One thing you do have to do is to keep it simple, right? Because as we mentioned, a lot of novice traders, they go through this period of adding more and more indicators to a chart, looking for that perfect combination of indicators to tell them when to get into trade, right? So they add more and more and more things to their charts, but they just can't make a decision. It's analysis paralysis. And part of the problem is that every indicator they add is just slicing and dicing the same information, price. And if all your indicators are based on price, then it doesn't matter how many indicators you add, you're still trading price, right? It's lots of bells and whistles, but dissecting the same information. So as traders progress, they tend to smarten up and realize that, more isn't really better. And over time, they start to drop the majority of their indicators and they keep the chart simple. And then they find order flow, hallelujah. And a lot of those traders, they saw the wisdom of keeping their charts nice and simple. They then go and make exactly the same mistake when they adopt order flow techniques. So instead of keeping it simple, bringing in one or two order flow elements at a time, they find every order flow indicator they can on the internet, add them to the screens, ends up looking like a pilot's dashboard, and end up with exactly the same analysis paralysis, right? So it pays to keep things simple. and not turn into a science project. And those that keep it simple, they will see progress literally in hours when they adopt order flow. Now, it doesn't mean in a couple of hours you're going to be profitable, but it means for somebody that's new to order flow, within 5 or 6 sessions of doing the drills that we set and drills that other people set, of watching the order flow for the first time, you're going to get this aha moment. You get this moment that says, oh my God, I can't believe that I traded without this information. And then it kind of becomes like crack for traders, where, you know, people don't want to trade without it, right? So this isn't something that takes years and years and years to master. It's something that you're going to see some payback fairly quickly, and then there's other payback that does take a while to learn, right? And we'll talk about which things to do first in a second. So the best way to look at order flow is not like an all or nothing technique, right? There are beginner and advanced techniques. So there's techniques to enter the market, there's techniques to manage trades, there's exit techniques. You can use this in very, very short day trading. I know traders that are in the market for seconds, I know a couple of guys whose average time in trade is less than 10 seconds, right? You can use this in longer term day trading, which is kind of my preference. To be honest, most of my trades 10, 15 minutes, and there's other people that like to stay in trades for hours. So what you first do is you first choose a benefit, an initial focus area, and you get the most from that benefit first. And by the most from that benefit, I mean real measurable improvement in your trade performance. And once you've squeezed the most juice out of that one technique, you move to the next thing, okay? But what you can't do is try and become an expert in all techniques in one go, because as keen as you might be, you will not learn any faster by trying to cram a year's worth of information or 6 months worth of information or 3 months of information in your head in an hour or a weekend. So I've seen people try to do this. I've seen people say, Pete, I watched 18 hours of your videos this weekend. I'm really raring to go on Monday. And I'm like, oh God, you know exactly what's going to happen. It's just got this head full of stuff. It's all confusion. So I've seen people come to order flow, quite generally, people come to order flow, and after 6 months, they say, I'm just not getting anywhere. And the first thing I say is, did you do the drills? The drills in the first email you got when we spoke. And the answer is no, not yet. And it's like, okay, do the drills. Yeah, but I've been doing it for 6 months. It's like, do the drills. A week later, they'll say, okay, now I see it. Okay. Now, for some people, the best place to start with order flow is trade management, the ability to cut your losers very quickly and let your winners run. And that's very simple, simply because trade management is really based on reading momentum, reading which direction the market's going in. A lot of the order flow techniques you use to enter a trade are based on the market doing one thing and then a sequence of events, cascade of events, where it goes from doing one thing, maybe moving down, to maybe sellers getting trapped and then some buyers coming in and then the late sellers getting stopped out. So it's a sequence of events that's not impossible to read. It just takes a little bit more skill, right? So momentum reading techniques, actually quite easy. Is it going up, and is the majority of trade on my side? Do I have a lot of trade on my side but the market stalled? Fairly easy to read when you compare to market reversal techniques, right? So with trade management, you should be making pretty big leap forwards in weeks, not months, not years, right? So let's have a high level view of what's important. So with order flow, you're interested in two things, and one is what happened before and one is what's happening right now. But it's the right now that is far more important, right? Too many people in trading only concern themselves with the results of prior trading activity. So if you think about cause and effect, the effect is what you see on the price charts. You can see what was the effect of trading. The cause is basically what caused that, right? And that's really the right now, right? So in this image from the 26th of February, which is just a couple of days ago, what we can see, we've got a chart here. We can see that earlier on, some traders got stuck in this area, very simply because these circles here, they just show an area that traded a lot of volume, right? So traders, we came down here, we traded a lot of volume into these prices, market moved up, very likely these traders got stopped out. Okay, so that's what I mean by looking at what happened before. This is just a few minutes after the open of the S&P 500 futures. So the X's here also show me what happened before. And in this case, what this is showing me is where the high volume was from the overnight session, right? So at 9:30, we open a day session. That high volume area just before the open is an area that often holds in the first few minutes. If you've never heard of this before, there's some videos on the site, but basically we call it the early trade, right? The colorful column here is what we're trading right now. So that's the new volume profile. On the center here of the Jigsaw depth and sales, we got something called current trades. And basically what that's showing, it's showing you what's trading right here, right now, this time round, no history. If you leave for a few seconds and come back, it resets, right? And for a lot of people, that's a really new concept to just, I'm only interested in what's happening now. And if it goes away and comes back to my price 5 seconds later, I don't care what traded there before, right? That's what we mean about this, about, really looking at what's happening right now, okay? So what can we see, right? So we can see a market, we opened at 59.25. We've got this high area of high volume that was built overnight, very close to the open. So we've got a sell order here and a buy order here, just to get in the queue ahead of time, hopefully to get swept into a position. These orders might well be cancelled. If there was like a lot of aggressive buying up to this level, this order would get cancelled. But it's just a matter of trying to get into the queue early. And what we can see, the market moved up and we ended up trading 690 contracts to 27.60. So there's 690 buy market orders that hit into the offers at this price, right? Now on the tape over here, we're only showing the large trades. We don't really care about all trades, all the one lot traders. We want to kind of see which side the big guys are on. It is mixed, but what you can see is the market's moved up from the open, and you can see all of these trades here. The buyers are no longer getting anywhere. Market's no longer moving up. So we're at an area where we expect a reaction. That's what these X's are for, because it tells us where we trade a lot of volume overnight, where we kind of held from a volume perspective. We've moved up, but we're now stuck, right? So buying is no longer causing the market move up. So what can we do? Well, what we can do is we can ignore it or we can sell it. Now, here's the beauty of this kind of setup and these kind of techniques, right? What we're doing here is we're leaning on the fact that buyers are stuck just right here, just right now, and that the market can no longer move up. And it's doing it in an area where we're kind of expecting a reaction anyway, right? Now, if we're doing that and we're leaning and we're relying on these traders being stuck, where do we have to put our stop loss? Do we have to put a stop loss at 65? No. We can put our stop loss, 27.61, roughly, 3 or 4 ticks away, and we're trading within a couple of minutes of the opening of the S&P, right? Because basically, if these traders are stuck and the market gets through, they're not stuck anymore. So here's the beauty of doing this kind of thing is you've got a very, very close stop, a very, very small risk, and you've got quite a good reward ratio. We could potentially see, quite often these bounces at the open, you could see it going down 7 or 8 points, right? Now we've got 2 resting orders here. That's just me before the market opens, just to say whichever side it gets to first, I'm going to get into a trade. Okay. So the problem with that order right there, though, is there's an order there, but there's actually, based on the activity here, would love to get in at that price, but based on the activity here, it's not going to get there, right? So I've got these 690 contracts traded here. It traded there for a minute or so, but long enough where you could see it was paused. There's no way it's going to hit this price. So basically, if I want to go short now, I can't wait for this to get hit because it's not going to get there. So I can jump in ahead of it. And that's what we did with a trade at 59.75. Now, interesting thing, what happened? We marched down. Now you can see on the current trades here that it's mostly sells on the way down. So this is the sell side. You can see the size, the rough approximate size that's selling on each price. And then we get to the bottom of this high volume area. Remember, the X is where the high volume was. What happens? What do we see? Okay. We see the same thing we saw on the same up, almost the same number of contracts as well. So we've sold 672 contracts into 57.25, and the market can't get through it. On the other side, the opposite side, we've actually bought 252. Now, if you look at the bids here, you can see there's 119 contracts bid or 119 buy limit orders there. In fact, all the time we traded this 672, we only ever saw about 100 bids showing, right? So as we traded, the bidders were basically hiding. They were adding more contracts. In fact, at this point, we've had 710 contracts added to the bids while we traded there, right? There were only ever 100 visible, but with this tool here, it actually shows you how many have been added, right? So if you've ever heard of an iceberg order, this is absolutely one. That's an iceberg order there. So as sellers sold, the bidders added bids, slowly trapping those sellers, trying to hide, absorbing all the selling, right? They're only going to do that because they want the price to go up. So not only have we stopped making progress to the downside, the buyers are being a bit sneaky, they're hiding their side. So just remember the 3 contracts here at 27.57. We've got 3 at 27.57 and about 670 at 57.25. And if you look now, 27.57, what do we see? Still got those 3 contracts. In fact, we traded about another 11 contracts at 27.57. And after trading that, market lifted up from there. And what can we see now? Another potential trap. So right now, we've got to a point we can see the size trading each level on the way up. And what can we see? We've got 1,076 traders bought at 27.61. And we're not going to keep going over what happened at each price. We can also see over here, we've got an alert on the charts as well for this, because it is excessive size. You get the picture, right? What we're doing here, we're just leaning on areas where price has got temporarily stuck. And we're doing exactly the same thing for entering the market as we are for exiting the market. And effectively, what we're trying to do, we're just trying to get good risk-reward ratio. We're trying to get out when a trade's finished, right? But really, the entries are all really just about good risk, right? So you could be wrong on a lot of these trades, and you could be wrong on 60% of your trades, and still be okay from a P&L perspective, as long as you're actually actively managing your risk and not just being a deer in the headlights and letting trades run against you. Anyway, so that's the S&P. Let's have a quick look at crude oil. Different setup, different kind of market. Now, in this case, we've got something quite different. It's called a volume spike. Now, you've all seen these, because I would guess there's not a person in the room that hasn't been on the wrong side of these. What happens is the market breaks and runs in one direction with huge volume. So basically, the market's going down. You feel like you're missing out on something huge. It's going down, it's going down. Oh my God, everyone's making money except me. I can't stop myself any longer. I've got to sell it. And there's the low of the day. The moment you sell it, the market stops moving down. We've all done that. And we all know the excitement, the fear of missing out, and the feeling of getting caught at the bottom. Now, I want you to remember that. Just keep in your head those times where you bought the high of the day or sold the low of the day, and why you did it and how you felt. Because that's all we're really talking about. That's all order flow is, and that's all really trading is all about, is kind of understanding that psychology of how do you feel, and then considering that other people, when they get stuck in the same position, that's exactly how they feel, right? So what do? So, we all appreciate how the traders trapped at the low feel. It is very scary. We can actually see a cluster here again. These circles here just indicate that a large amount of volume occurred at those specific prices, right? So what we've got in this move down, we've got an area where a huge amount of trades hit there. And obviously those traders trapped at that low are probably a little bit scared. What's also a scary trade for a lot of people is when they see this big volume spike to the downside. Scary trade is buying it, right? It's a really difficult time to buy when you see that thing, but a little bit less difficult if you actually understand order flow. So these fast moves, they often end with a cluster of large positions. That's what the circles show. An excessive amount of volume over a small range of prices. We can also see below us, there's a really big bid. This 629 contracts here bid at 51.97, right? Those bids are kind of nice to have. It's kind of interesting, but they're actually not that important. What is important more than anything else is these positions, real real traders, really feeling like they've just sold the low of the day and kind of waiting with trepidation of what's going to happen to them, right? That makes it a real make or break point. So once the market starts pushing up through those traders positions, think about it, you sold the low, you can see the market start to lift up. It starts to lift up, it starts to go over your entry point. What do? Well, there's a couple of things you might do. You might be like the deer in the headlights and just stay in the trade, stay short as the market moves up past you. Most smart traders are quite happy to just say, okay, I'm wrong. Market's going to go up. I'm going to get out of the trade. To get out of the trade, what do you have to do? You have to buy, and buying is going to push the market up a little bit more, and then you get this little stopper, and you get this kind of initial first push because people are bailing out of their trades, right? Now, you'll see in any volume spike, you will see these volume clusters all the way down. So there's one here too, exactly the same kind of thing, right? The key, though, is when the market actually pushes back up through one of these areas. So what happened here, a lot of people actually got engaged in the market here, probably maybe some bids. There's some bids in the market, but it just drove straight through. There was never a point at which those traders felt threatened. Might have stopped for a few seconds, but in this case, market moved through, started to climb back up. It's a very, very different scenario. So we're not interested in this scenario. We're very interested in this scenario. We're not interested even in buying at the low. It's quite okay to buy above this area here because that's where we've got the most confirmation, right? So basically, market starts to move up through those traders' positions. They get stopped out, and their stops trigger more of a cascade, a push to the upside, right? So if the market doesn't push up, you've got no trade, right? So if you see if you see a cluster of volume, but the market doesn't start to push up, there's no trade. There's no feeling that these guys are getting stuck, that they're going to panic, they're going to exit, they're going to cause the market to push up. If there's no cluster of volume at the low, the market just moves up, you've got no trade, because it means there's not a significant amount of people positioned at that area to say, yeah, these guys are going to get stopped out soon, right? It might go back up, but for an order flow trader, you don't have as good a signal as when you've got some people in pain, right? So if you have both, you have the push up, if you have the cluster of volume, it means that sellers are getting stopped out, and that causes more profit taking from the people that sold that even didn't get out yet. So you're going to have people selling here when they get stopped out, but you've got people that sold, sorry, you have people buying here, then the market got stopped out, but you're going to have people that sold all the way down here that are quite happy. If you sold down here, you're still quite happy, but as the market ticks up, as you see the first stop run from these guys, you're also going to start to unwind that position and get out of it, right? Because you can say, okay, well, that move's probably done, right? And this is something that happens a number of times a day. Most days on crude oil, same gold, natural gas, happens multiple times an hour on markets like the DAX, really, really kind of wild, volatile markets. But it's the same deal, right? It's about other traders' positions, them getting caught out, how traders are trading around those positions. So, not all order flow is about people getting caught out, but it's always about other traders, about concepts that you can, really relate to, not like, this line crossing over that line. That's an abstract concept that tells you nothing about the actual behavior occurring in the markets at that time. So the common theme with order flow, really, there is one. It's all about other traders, their positions, their fear of loss, them protecting their winnings. So the key, really, when you're reading order flow, is just remembering how you felt in those situations yourself, and then trying to say, okay, well, I think that situation is playing out now. Do I have a place where I've got actually low risk, a good decision point where I can say, right, at this point, if this is holding, and if it doesn't hold, I'm wrong, and if it does hold, my potential reward is far, far greater than my risk, right? One of the mistakes you can make with trading is trying to be right all the time, right, and holding on when you don't feel, you're not sure, but I'm not sure, it doesn't look like it's working, it's ticking against me, but I'm going to stay in anyway, right? If you can put that to one side and say, right, I've got a good risk reward ratio on this trade, I believe that if it gets a few ticks up, I'm going to scratch the trade, and if I'm right, I'm right, and that can take care of itself. So you start off with refining your trade entries, or using momentum for trade management, or even using order flow to tell you to scale into trade. So maybe you don't even use it to enter the market. You just get into the market at the same time. But when you've got that order flow, that momentum on your side, add some more contracts as you go. But whatever you do, as you add more techniques, you're kind of building layers, building this foundation of knowledge, building this layer cake of trading knowledge, and not just starting again. Because our recommendation is always, when new traders come to us, is try and salvage what you've already learned. Okay, so we would rather a trader keeps what's working for them and enhances it than to start again, right? Because if you think about most retail trades, the guys I spoke for, they've been doing it for 20 years. I'll say, what have you tried? And they'll say, well, how long have you got, right? I've tried hundreds of different things. And every time they tried something new, it was starting again from zero. There was nothing they had from the last technique they could bring to the next. Now, of course, if you're trading like moon phases or the color of your favorite morning show host's t-shirt, probably going to have a rethink about that, right? There's probably not a lot that you can bring forward. But, you know, for a lot of people, they've got some sanity to what they do. Now, earlier on, we talked about measuring progress, and that's something, there's kind of two ways to look at measuring your progress. First, there's kind of an intuitive measurement that's very difficult to measure. So there are trading drills, exercises that actually help you read order flow and help you read a market. And with those drills, you're going to be really, really bad at them. So you experience the progress kind of firsthand and more intuitively. So you do a drill, like for instance, we've got one called a cut and reverse drill. And it's about staying in the market all the time and just switching your position from long to short, short to long when you think it's the right time. When you first start doing that drill, it's very painful because you'll be wrong almost all of the time. You'll keep switching in the wrong place. But as you do the drill more and more, you'll actually get better and better and better and better. It's not really about P&L though. The improvement you see is very intuitive, and you feel it, you know, you just feel it you become better at it, you become more successful. So, you know, it's like riding a bicycle, right? You know that you're no longer falling off the bicycle, you know you've got the trainer wheels off, and it's that's one kind of measure of improvement, right? An intuitive improvement. But the other improvement is obviously trading performance. And in the thick of trading, it is a little bit more tricky to track your trading performance and actually track what's working and what isn't. So we do recommend using analysis tools like the Jigsaw Analytics here. They come free with the Jigsaw software, and they break down your trade history and profits lots and lots of different ways, right? Instrument, you can break down by type of trade, you can break down by time of day, you can break down by trading account, day of week. We've got a trader right now, it's actually this trader here. 50% of his trades are on the DAX, a very, very volatile market. 50% of his trades are on the S&P. Almost 90% of his losses are on the S&P. So 50% of his trades are on DAX, 50% on ES, about equal in terms of how much they contribute each to his wins, but most of his losers are on the S&P. Now, whether he stays with the S&P or not, that's completely up to him, but it is good to know those things, right? So, you know, you might, for instance, find like this trader here, he shouldn't really be trading at 5 o'clock in the evening because basically that's a net losing time for him. He probably shouldn't be trading on a Friday, or at least he should find out and kind of look into the Friday time and actually find out what it is he's doing that's causing him to make money, make money consistently. And we're talking about a couple of months worth of data here on Monday to Thursday and lose consistently on a Friday. So, it's good to have that intuitive feel for your improvement, that better feel for the market, that kind of patting yourself on the back that you're actually doing better, that it's going better. But it also helps to analyze the progress, technically, to find patterns that, you might not see in the heat of the battle. And it's a bit like panning for gold, right? You might have a tray of what looks like dirt, but there could actually be some gold in there. Now, onto the Q&A. If you've got any questions, now would be a good time to type them in. Let me just open, see what the question box. What I've showed you today is just a peek at order flow and techniques that are used daily, on a daily basis in proprietary trading firms. In fact, we work very close to the firm in the City of London to provide educational materials for traders. What I'm not going to do today, I'm not going to give you a big sales pitch because I'd rather get to some questions. I'm not going to have you visualize yourself parking your Ferrari by your yacht and telling you about the riches you'll gain. I'll just say this. If you're sick of being told where to get into the markets and not why, and seeing those techniques fail, this is something that you should actually take a look at, something to consider. Something where within a couple of weeks, if you're looking at order flow for the first time, you're going to drastically change your understanding of the markets with things you can see yourself in real time, not things you can take on faith, things you can see yourself. It's not going to make you an expert, but it's just going to open your eyes and wow, this is something I really need to focus on. And if you don't see those things in the first 2 weeks, you get your money back. We don't charge you a thing. Okay. And today, to kind of sweeten that deal a little bit, we do have a coupon code that expires in 24 hours. It's a February special for $100 off. So now, do we have any questions? I don't think we do. But if we don't have any questions, I will give a minute just as I close out. If we don't have any questions, please feel free, go to the Jigsaw site. There's a blog on the Jigsaw site. There's plenty, okay, we have a question. Plenty of videos on the Jigsaw blog. If you're wondering, you know, plenty of trade videos. There's actually a category for trade videos on there. So if you're wondering how this kind of stuff plays out in real time, please go and have a look there. Okay, right. How did you get the data for the X's? So I drew some X's on the, this is so low tech, right? I drew the X's on the slide earlier to say where the volume is overnight. So overnight, what I'll be seeing, I'll be looking at something like this overnight, where I've got the histogram. And what I'll do before the market opens, I'll come into this column here and I'll put the X's in. So literally every day before the market opens, I'll look for volume close to where we are now. So if the volume's like 10 points away on the S&P, I'm figuring those positions are probably already washed out, probably not in the market anymore. But if it's within like 10 ticks of where we are, I'll just look at the volume and I'll say, okay, that's where the kind of significant volume is leading to the open. And I'll just put the X's in myself. There's no, it's kind of low tech. I like to do it myself. James asking what's wrong with trading moon phases. I would say nothing if you're a werewolf. Is the bottom histogram on your setup more or less your version of using advanced decline line? Okay, what I've got here, there's two things at the bottom here. There's this line, the white line here is cumulative delta, and that is the buy market orders minus the sell market orders. So basically what you can see as we move up here, the market is imbalanced to the sell side. There's a lot more sell market orders. That works better on less volatile markets like the S&P, interest rate products, for various reasons. But the main reason is on a market like the DAX, right? If you wanted to get into the DAX with how volatile it is, you could put it's quite reasonable to put an entry, a bid 3 or 4 ticks below where the market is and just presume that the volatility overall will let you in. With a market like the S&P, quite often you have to get in with a market order. So when there's a lot more people entering with market orders, this measure here, which is buy market orders minus sell market orders, actually makes a lot more sense. So what you tend to see is in a trend, the delta will be kind of, you know, in an uptrend, an intra-uptrend, the delta will be, you know, pointing upwards. And then when there's a pullback, the delta will be absolutely flat. So even though the market might pull back 8 or 9 ticks, there'll be no adjustment in the delta when it does that. And what it means is the market's pulling back really more because of a lack of liquidity on the buy side than overwhelming sellers. So that's the cumulative delta. And then below that, this is just the volume. And again, it's blue and red. Blue just represents the volume of buying, and red is the volume of selling. So it's basically just to try and just to get an eyeball. Always have an eyeball on the balance of trade. Also, the colors of these bars, the green is for bars where there's more buying, and red where there's more selling, right? Lewis is saying I'm awesome. I know he's saying the webinar is awesome. Okay, that's good enough for me.